Shankar Sharma is of the view that do not buy tickets for that buffet because markets currently are priced to perfection. He joins us from Dubai with his current market outlook. Shankar, what a delight to have you back on ET Now. Thank you for joining us. Before we get into specifics, here's wishing you a very happy Diwali from Team ET Now.
Yeah, that's exactly. I mean, that pretty much sums up the entire market situation. That the broad market has not made its highs, and while the Sensex has done so and the Nifty has done so. And those kind of markets are always fraught with a lot of danger, and I've rarely seen markets that are so narrow sustained for very, very long. So the markets, when they were falling prior to September, they fell on the back of largely bank stocks. So at some point, when you have vertical falls in a large cap sector like banks, you are setting yourself up for a vertical rally as well. So my view in the early part of September was that we would witness some degree of rally from the lows that we saw in August, and more importantly, my view was that we would not see any taper happening in the September 18th meeting. I mean, that was again not a popularly accepted perspective, but my view was that the Fed had way overshot itself in terms of being optimistic on the US economy. The data was not at all robust enough to support any rollback of the stimulus. And when you're growing 2% or so, I mean, that's hardly earth-shattering. And remember that 2% or whatever the GDP growth numbers have been generally for the US, there is a reasonable amount of the 2% is coming from this very stimulus. So when you roll that back, then you're probably looking at a severe cut from the 2% growth rate. So I didn't think there was any case for the Fed to announce a taper and be consistent with that view. So we turned bullish in the first few days of September, and accordingly, we advised our clients to move away from being underweight emerging markets and overweight developed to pretty much reversing the trade, because again that had become a crowded trade. So because everybody, had been short emerging markets from let's say July, August. So when it becomes so crowded, obviously markets tend to reverse. And coupled with this view that the taper wouldn't happen, we were reasonably optimistic the markets would rally. Globally, emerging markets would rally and India would rally as well, because it had fallen largely because of banks. So when you have large banks falling 50% in a matter of 4 months' time, that simply can't sustain. You have to have reasonable rallies. And that's pretty much what we have seen. But the problem now we face is that the broad market has not rallied, and the rest of the sort of market outside of the top 15, 20 stocks, they are looking very, very sort of morose, because they have not really participated much. And that doesn't portend well for the longevity of this entire move. And that's in a nutshell, my perspective, that I doubt if you have incremental, reasonably big upsides left in the marketplace.
Shankar, hi. Happy Diwali from me as well. How are you approaching the market now? Are you getting a little cautious with the market at this peak?
Unfortunately, the market doesn't know when it's Diwali. So, we have to figure out a trade irrespective of what public holidays exist. My view is that, it's time to take money off the table. Even if you miss the last 500 points of the Sensex, it's okay. But I'm pretty clear that, you're looking at, 2014 being difficult for markets globally. It has been very difficult this year, to say the least. It's been all over the place. And I don't think 2014 is going to be any different. It could be a lot worse by way of unpredictable moves, as compared to even 2013, which has been bad enough. So given all that, you're at highs. It's been very, very narrow, unsupported by the broad markets. All those things give me enough room for concern. So the trade that is building up is a trade which will be not on the upside but on the downside.
Shankar, should one be bearish on equities at a time when global liquidity does not look like it is going to dry up any?
I never buy all this liquidity nonsense. I mean, by that token, markets should never ever have come down ever in the history of the world, because the Fed has always had an easy money policy by and large, because the Fed really wants Wall Street to prosper, and thereby by some convoluted logic benefit Main Street. It never quite happens that way, but that's another matter. So I mean, I never buy. These are self-serving arguments spun out by people trying to protect their jobs. Markets will rise, markets will fall, irrespective of how much liquidity you've turned on. When markets rally and there is liquidity, then you say, look, it has happened because of that. But when markets fall and there is still liquidity, then you say, hey, it was just an aberration. So, there is hardly any correlation between the two things. That said, I think the real cause for concern for all of us should be that despite record liquidities in the marketplace globally, markets are struggling to take out their highs internationally. For India, just about made its way there, and that too on the back of very, very narrow set of stocks. But elsewhere, the US has been fighting with its, a 14-year S&P level for the last many months, despite this much liquidity, despite $85 billion a month. So that's a real number that, should be worrying all of us, that why isn't the market able to roar back and continue on its bullish path despite being so much pumped up with liquidity? Why is it having to struggle so much? That's the real problem here. So, I don't buy this whole liquidity logic. Markets can go anywhere.
Shankar, markets are extremely polarized. Only 15-20 stocks are moving up. So sectorally, what are you betting on?
Autos, by and large, we've liked in particular, a stock like Bajaj Auto, we've liked quite a lot. And in particular, when the rupee was falling, because when you have 35-40% export numbers coming in from Bajaj Auto, even though the domestic market has been struggling, the export side will be benefited. So we have liked autos. That's not something that we've not liked. Banks we have hated from March onwards, and we started to like them, in the first week of September, because obviously you can't have large banks falling 50% in a matter of 4 months' time. So we've liked banks as a big trading rally.